Good day and welcome to a presentation by Stein Sperling on the tax provisions of Public Law 116-136, the so-called CARES Act, and we're also going to look today at other current federal tax relief. I hope that everyone is well. As I mentioned, this program is going to focus on the tax developments arising as a result of COVID-19. My partner, Mark Schweighofer, and I will review the provisions of the Act and other federal tax relief that has been granted. And we are going to begin with the provisions of the Act that affect individuals. And the one that has had the most publicity is because of the immediate benefit, and that is a credit that will take the form of a rebate. Individuals with incomes under a threshold amount, $75,000 for single individuals, $150,000 for married couples, and right in the middle, $112,500 for heads of household will get an immediate rebate of $1,200 plus an additional $500 per qualifying child. If you are married, you will get $2,400 plus an additional $500 per qualifying child. It will be based on your income in 2019. If IRS has processed your 2019 return, if it has not, it will be based on income shown on the 2018 return. There is a phase out in your ability to receive a rebate. The rebate is lost based on in a $5 taken away for each $100 that income exceeds the threshold. If you have no qualifying children, you will not get a rebate if your income on the return that is looked at is in excess of $99,000. If you are married, if your income is in excess of $198,000. And if you are head of household, assuming no children, and that is possible, I'll go into that momentarily, $136,500, you are phased out. The test for a qualifying child is the same one as used for the child credit. The child must be under the age of 17, and apparently IRS will look at who claimed the dependency allowance, and because it can be shifted from the custodial parent to the non-custodial parent, it is possible that someone claiming head of household will not get an additional child if that dependency allowance has been passed on. If you filed the return that is looked at by direct deposit, you should be receiving your rebate into that same bank account if it is still open, beginning the week of April 13th. For those who received refunds and did not have them put in the bank account directly, or if you changed bank accounts, or if you paid taxes in the applicable year, you will get a check by mail. The bad news is that it could take as long as 20 weeks, and it will not start until early May. Now, the important thing here is that this is an advance toward 2020. The 2020 return will show a credit that you can take of up to the same amounts you're seeing here on the rebate, and you must subtract the amount of the rebate that you received. So some people will get a credit on their 2020 return, particularly those whose incomes dropped and were not able to get the rebate. For those whose incomes went up, perhaps, you will not be required to return or to adjust your tax liability by the amount of that rebate. Mark, anything to add?
The only thing that I think I'd add to the summary, Dave, that you put forth is there was a lot of questions initially when this came out about folks who perhaps were below the income tax filing threshold or who otherwise didn't have to file tax returns. And recently, IRS and Social Security came out with some guidance earlier this week to indicate that Social Security recipients don't need to do anything either in order to claim the credit. If they're getting Social Security benefits or SSI benefits, those amounts will be processed will be processed through in the same manner as folks who have filed tax returns. So if they have direct deposit information, it'll come through that way. Otherwise, it'll be a physical check, and I believe it'll be subject to the same delays in processing that the physical checks will be for tax return filers as well. But beyond that, I think that was a pretty comprehensive summary on that first credit. I guess the other piece on this is, and we'll try and touch on these as we go through, there's been obviously this is sort of an unprecedented situation that our country is facing, and there's been with it sort of an unprecedented amount of legislation that's passed in the last several weeks. Some of those provisions interact with each other, and we'll try to point that out to the extent we're aware of it at this time. This credit, Dave, as far as I am aware, does not sort of reduce the taxpayer's ability to take advantage of any of the other relief that's out there.
That is correct. Now, we represent a number of non-filers, and individuals who have not filed 2018 or 2019 will not receive a rebate, with the exception that Mark mentioned, because IRS will be looking at the information returns for Social Security recipients. So these individuals will have to wait and claim the credit on their 2020 return. Now, what is not clear are individuals who are not claimed as dependents for one reason or another and did not have to file returns for reasons other than getting Social Security. Perhaps they got some other exempt income on which they lived. So we've got to wait for some guidance in that area. The legislation allows on 2020 tax returns, everyone, even if you do not itemize, the ability to deduct $300 for cash charitable donations. The feeling is that a number of charities are going to be hurting as a result of the current situation. And in addition, the 60% AGI cap on cash contributions will not apply in 2020, allowing individuals of means to deduct larger amounts if they do have that charitable inclination. The legislation also expanded on the deduction that is available for job-related expenses, for employer payments under an educational assistance program, not necessarily relating to one's job. Such a plan can allow up to $5,250 tax-free to the employee each year, and that is normally to go to tuition, room and board, books, and similar. For 2020, after the date of enactment, an employer can pay down student loans of an employee as part of the existing employee educational assistance program that it might have. Or, of course, it may create one going forward. Note that this cap does not apply if the education costs are job related, in which case there is no dollar limitation, but the payment of existing student loans in any event is maximized at $5,250. Retirement plans. The minimum distribution rule has been suspended for 2020. Some of you may remember that this happened in 2009 as well, in order to protect retirement monies during difficult times. And there's a little wrinkle for those who first had to take a minimum distribution by April 1 of 2020 and did not do so. The language of the statute appears that you will not be penalized for failure to take that minimum distribution. That was really for 2019, but that first year, when you still had the old 70 and a half age for commencing minimum distributions, if you hadn't done it by the time of enactment, then you apparently will not be charged with a penalty. And for 2020 required distributions, including those liable for the very first time, now at age 72, you do not need to take a minimum distribution. Now, this applies to IRAs and it applies to defined contribution plans. It does not apply to defined benefit plans. In addition, if you are in the 5-year period where there was not a designated beneficiary, or there was and you did not commence annual distributions by the second December 31 following death, you will have an extra year. In other words, the 5-year period on getting everything out of the account is extended for 1 year. Some of you may observe that the legislation that was enacted in December of 2019 creates a 10-year maximum period before you have to get all monies out of inherited retirement plan accounts, with some exceptions, including spouses. But the 2020 is the very first year of that provision, and it only affects death in 2020 and subsequently, and that 10-year period is measured from December 31 of 2020. So the 10-year period is not affected by the suspension of the minimum distribution rules for 2020. The 10% early withdrawal penalty for distributions in 2020 up to $100,000 from most employer retirement plans or IRAs will not apply. So even if you have not reached the age of 59 and a half, you will be able to take $100,000 out of your qualified retirement plan or IRA. You will be taxed 1/3 of the withdrawal amount in 2020, 1/3 in 2021, and 1/3 in 2022. You will be allowed to recontribute within 3 years from the date of the withdrawal. And now, in order for this provision to apply, either you or your spouse or a dependent must be diagnosed with the virus, or you must be able to show an inability to work due to quarantine, furlough, closing of the business, or reduced hours. What this does not appear to cover on the surface is if you simply have reduced income, and what else does not appear to be there is if it is your quarantine, or furlough, closing, or reduced hours, and it is your spouse's retirement plan that you wish to withdraw from. It seems in a literal reading of the statute that it must be you who has suffered in order for you to take from your plan. Mark, anything to add?
No, I think that's right. You know, and again, the studies I think that you've seen in terms of what individuals should look at in times of crisis is, you know, taking money out of retirement plans is, if you believe everything that the financial advisors will tell you, and I think the data is there to back it up, should be sort of a thing, an action of last resort. Even though this does give a tremendous amount of relief, you know, hitting your retirement plan is something that obviously, you know, takes away some of the tax-free compounding that can be there for you as it grows. Now, obviously, with the current market conditions, that's in a little bit of a state of flux as well. And obviously, Congress is focused primarily on getting cash into the hands of the people who need it the most. So you'll see a lot of provisions of a similar vein as we walk through this.
And that point is very well taken. You ideally do not take from your retirement plan when the market is down. And also, if you're unable to recontribute it during this 3-year period, you're going to be faced with a loss in federal and state taxes of perhaps 40% or thereabout, and that may cause some financial issues of its own. By the way, employers have been told to accept on face value what employees have relayed to them concerning the hardship. Now, there is one provision I have not seen, and that is whether if a plan does not have a hardship withdrawal provision, can the employee still take money out? I have not seen anything on first and second reading that says an employer must add a withdrawal provision if in-service withdrawals are not permitted under the current draft of their retirement plan.
Yeah, I agree. I've seen a lot of commentary that say it's plan amendments are going to be liberally construed, but I have not seen anything that specifically requires plan amendments for that purpose. So on my read of it as well.
And we have similar abilities concerning loans from retirement plans. We've got a couple of benefits here that from the date of enactment last week for a 6-month period through September 22, 2020, you can borrow from your retirement plan up to the lesser of $100,000 or 100% of your vested balance. The normal limit is 50,000 or 50% of your vested balance. What I believe continues to apply is that this is looked at in tandem with existing loans. And if you currently have amounts borrowed, your ability to do new borrowing is not going to be the full $100,000 as I read it. There's also a provision under existing law that I did not see ended, and that is a maximum of 2 loans outstanding. If that in fact is the case, and you want to do this higher borrowing, you may need to pay back one of your existing loans to get this greater amount out of the plan in the form of a loan. Eligibility is similar to the eligibility for a withdrawal from the plan. And again, I think that this is not available in plans which have not amended to permit plan loans. In general, most employer plans do permit borrowing. Now, on to the business side. We have a provision in the statute that provides a refundable, meaning that you can get money back if your tentative liability came out to less than 0. The legislation provides a refundable employment tax credit of 50% of the first $10,000 paid in wages. And for that purpose, you may count health insurance as wages. This is on a per employee basis and measured from wages paid beginning March 13, 2020, for any quarter through year end where the employer is fully or partially shut down by a governmental authority due to the virus, or if you are not shut down, you must show that your quarterly gross receipts declined by more than 50% based on comparing it with the comparable quarter in 2019. Your ability to claim the credit, if you're going that route, ceases when you have hit a quarter where an 80% level is attained. And for businesses of more than 100 employees, the credit only applies when employees were not providing services due to the virus. For smaller employers, the credit will apply even when the employees are at work if you otherwise meet the eligibility. Mark, do you want to elaborate on a couple points?
Yeah, so a couple of things. One, the employees is based on full-time employees. So that 100 or less employees is based, that is determined basically under the same rules that are used for determining whether or not you're required to provide health insurance under the Affordable Care Act. So 4090, 4980 cap H are the rules that you would look to determine that. So there you run into the issues, I believe, of looking at not only full-time employees more than 30 hours a week, but also sort of doing computations for those employees that may be less than that, but when added together may aggregate up to a full-time equivalent employee. In addition to that, and sort of when you look at the regulatory scheme or the legislative scheme that has come out, and it's apparent in a lot of the tax provisions, it's apparent in a lot of the lending provisions. Congress is intending to use businesses to get money into the hands, to subsidize businesses to get money into the hands of workers. This is obviously designed to keep people on payroll for as long as possible by providing by providing a refundable credit. And there are limitations, of course, on this too. If you're eligible and obtain some of the loans under the CARES Act, whether it be the Paycheck Protection Program loan or the disaster recovery loan, and you use that to pay this purpose, the credit's unavailable for that as well. So you can't. There's a lot of things in the legislation that don't allow taxpayers to double dip, and this is one of those provisions. So it's important, I think, for business owners to sort of sit down and plot out what relief package they want to take advantage of and when, because there are certain timing and ordering principles that need to be factored in to that analysis in order to sort of maximize your benefits under these stimulus packages.
Assuming that you go this route at the risk of being ineligible for forgiveness of loan indebtedness under other provisions of the Act, note that this expires at the end of 2020, irrespective of if you are going based on a loss of revenue as compared from 2020 back to 2019. If you have not gotten that 80% level by the end of the fourth quarter, the benefit still will terminate at the end of 2020. There is an ability to defer the payment of the employer portion of Social Security taxes and up to 1/2 of the Social Security tax paid by self-employed individuals, effective with enactment in late March and throughout the year. 1/2 of it must be paid by the end of 2021 and the balance by the end of 2022. And Mark, I think this is a situation where people who have financial difficulty and take advantage of it, a lot of them are going to have a hard time coming up with the back tax money in 2021 and 2022. Fortunately, it is strictly the employer portion that is deferred, so individuals cannot get hit with personal liability under the trust fund recovery penalty.
Correct. And in addition to that, there are some limitations on the ability to use this. One of the things we'll talk about a little bit later in this discussion involves some expanded sick and family leave that is required for employers with 500 employees or less. There's a refundable credit that goes along with that program. You can't defer the portion of the employer portion of the Social Security taxes that is used to pay those expanded leave benefits, again, under the concept of no double dipping. And then similarly, with the Paycheck Protection Program loans that are designed to allow businesses to pay payroll here after, for an 8-week period after they receive the loan, and at the end of that, if they use the loan for permissible purposes, that loan will be forgiven. To the extent the loan is used to pay employee wages, which is the primary purpose of those loans, you're also not eligible to defer 1/2 of the Social Security taxes on that either. So but once you're, to be clear, once you've exhausted that Paycheck Protection Program loan, you'll have full eligibility to utilize this deferral program going forward through the end of the year. And it is anticipated that, from the Paycheck Protection Program loans, most people will have used those proceeds up by the end of June, if not sooner. So this provides a little bit added relief going forward as we head into the third and the fourth quarter of the year.
Mark, I don't know if you looked at this part closely, but as I read it, it only applies to the Social Security portion, which is 6.2%, and not to the 1.45% Medicare portion. Is that the way you read it, if you've had the chance to look at it?
That is the way I read it as well. The logic, I'm not certain I have the logic behind it, but that is certainly the way that it's drafted, and I think the legislation is pretty clear on that point.
Net operating losses. The legislation in 2017 repealed NOL carrybacks except in the case of farmers. However, to help distressed businesses, net operating losses from 2018, 2019, and 2020 may be carried back 5 years and will be allowed to fully offset income. And of course, that will mean in the case of 2018 and perhaps some 2019 returns, the necessity of filing amended returns, but it will definitely allow a number of companies and individuals to obtain refunds. Now, there's a point I didn't pick up on, and Mark, perhaps you have. If not, it's something to be looked at, assuming that you go back 5 years and you have not utilized the NOL in full. As you carry it forward, are you still going to be subject to the 80% rule, or will you be able to offset 100% going forward?
So my understanding on that, on the NOL carry forward rule, is that for going forward through 2020, you're going to be able to utilize it at and through 2020, you can utilize it at 100% of taxable income. After 2020, it's going to revert back to the 80% of taxable income again. So it behooves everybody, I think, to go backwards as much as they can and to utilize whatever losses you have in the prior years to obtain those refunds. Because going forward, you're going to be subject to that 80% of taxable income limitation again. Obviously, particularly for C corporations, this is a big benefit to them. The carryback, particularly if you can carry it back into years before 2018, when the rates, with the TCJA and the decrease in the rates on the corporate side to a flat 21%. You're going to be able to carry that back and take advantage of, the rate difference too. So you're going to get some rate arbitrage on that I think will provide some much needed liquidity to businesses in this time.
And a second bullet point, the 2017 legislation limited the ability of individuals who had ordinary losses on their tax return, an inability to deduct more than, I believe, $500,000, 250,000 in the case of an unmarried individual. I hope I got those numbers right. In any event, I won't have to worry about it until 2021. That provision in the 2017 legislation has been suspended retroactively for 2018 through 2020. And again, possibility of amended returns. In the case of farmers, the return to the ordinary loss limitation will not occur until 2027. C corporations, historically, C corporations have only been able to deduct charitable contributions up to 10% of their tentative taxable income. For 2020, they may deduct charitable contributions up to 25% of the taxable income as determined prior to the contribution. And C corporations that had unused alternative minimum tax credits when the AMT was abolished for corporations, it was supposed to be spread out over a number of years. You may now utilize it in full in 2019, or you may elect to file an amended return and use it up against regular income on a 2018 return. And lastly, and very, very important, for the last 2 years, Congress has been debating whether to have a broad Technical Corrections Act, and about the most significant provision where the legislative history was different than the actual wording of the act dealt with the write-off period for leasehold improvements to commercial property, either by landlords or tenants, and this particularly affected the restaurant industry, which we know is potentially, along with the cruise ship industry, the hardest hit by the current situation. Because of an error in drafting, leasehold improvements to commercial property were to be treated as 39-year property rather than as 15-year property, as 39-year property unless they were of such a modest amount that you could write them off under Section 179. They would have had to have been written off over 39 years. However, this legislation gets the statute, gets the law in sync with the legislative history. Leasehold improvements to commercial property retroactive to 2018 are 15-year property, and that allows for 2018, 2019, and for a couple of years going forward that they be written off in the year they are incurred using bonus depreciation. Very important. Mark, anything to add?
Well, I mean, it took a global pandemic, but they finally got to the spot that they intended to be all along, I think, they being Congress. So that it is good to see. It is, you know, obviously the business community was very receptive to this technical correction. I think the other thing to keep in mind, going back to one of the things we talked about a few minutes ago, the ability to use bonus depreciation, and you can actually create a loss in the current year or any of the, any of the immediate past years. Combining that with the ability to carry those losses back for up to 5 years from the current, from current will, potentially generate pretty significant refunds to people, and in a much needed time. You mentioned the restaurant industry, commercial real estate will also benefit significantly from that, and tenants building out, commercial space. So it's going to be, this is a very welcome development, and one that I think we had all hoped and maybe even expected would come before this, but it's here now and we'll take advantage of it.
There are a few other developments related to the coronavirus that were not part of that comprehensive legislation. About a week before Public Law 116-136 was the Families First Coronavirus Response Act, and it was designed to require employers of less than 500 employees to provide paid leave under certain circumstances. And there is a 100% credit for the required paid leave of such employers. The dollar figures and the percentages are based on what employers must pay individuals who are quarantined, who are seeking medical diagnosis, or have family care issues, and there will be a credit of 100%. Note that most of the time periods are 10 days. However, if the care that is required arises because of a school or daycare closing, a credit will be available for the amount that an employer must have to pay for up to 60 days, meaning 12 weeks of 5 days a week. Mark, some things to add?
Yeah. So it's obviously, it's 100, as Dave mentioned, it's 100% 100% refundable credit, and basically the way it works is you get a credit against the payroll tax deposits that would otherwise be made by the business during this period. There's also a provision in the legislation that says if the payroll tax deposits for the applicable period are insufficient to cover the leave pay, that it has to be advanced because of the Families First Coronavirus Response Act. There is an ability to complete an advance request and submit it to the Internal Revenue Service. That's done using a Form 7200, and IRS is the aspirational goal, at least pursuant to the news release, is to have those amounts funded back to the employer in short order inside of 10 days. Now this is relatively obvious. All of this is relatively new guidance, and it remains to be seen on how efficient the service will be on processing these requests. But nonetheless, this is again designed to use businesses as sort of the go-between between the federal government and the ultimate recipients of the financial aid through this, which are the individuals who are facing a reduction in wages or lost employment or something along those lines, to keep them on payroll for a little bit longer. Separately, and I think we mentioned this previously, but if you're a business owner and you do provide and you apply and are granted the Paycheck Protection Program loan, you cannot use the loan to pay this expanded family leave. It's not a permissible purpose, and it won't be eligible for the loan forgiveness. as part of that. So that's something, again, to keep in mind. And there is, through this, one of the things I think business owners are really struggling with is there's a lot of information and it's coming out incredibly quickly, but there is some strategy in terms of, what benefit you're applying for and when. And I think, again, plotting a course in terms of how you're going to navigate these next few months, that will undoubtedly have some choppy seas. The folks who plan the best, I think, will emerge stronger when we get back on our feet.
Notices 2020-17, 18, and 20. Collectively, we might call it the accountants and tax preparers relief provisions, extended the April 15 filing and payment deadlines for individuals, corporations, partnerships, and fiduciaries that had that April 15th deadline. So it extended both filing and payment until July 15, 2020. No late filing penalty, no late payment penalty, and no interest as well. This also applies to gift tax returns that would have been due April 15th. They are extended, as well as the rare required payment, to July 15. Beyond July 15, individuals and everyone else will need to file an extension if you want to go to the extended due date. And this also included estimated taxes that would have been due on April 15th. So, Mark, this creates a bit of an anomaly that the second quarter estimate is due, as I read it, still on June 15th, and your first quarter estimate is due on July 15th.
Yep, well, I agree with you. I read it the same way. We're in interesting times for sure. A couple of points to just note on this are things that were not necessarily extended by this extension, and that involves a lot of information returns. For example, taxpayers that have to file a Form 3520, which is that for at least to the extent that you're reporting a receipt of a foreign gift, or to report interactions with foreign grantor trusts. Those are standalone forms. They're not attached to a taxpayer's 1040. Those deadlines are not extended. With respect to the 3520 in particular, the only way to extend that deadline is to file an extension for your individual income tax return. So notwithstanding the guidance that Dave had mentioned that, there's no extension required to get you to the July 15th deadline, if you have to file a 3520 as part of your normal tax filings, the only way to get the extension and to do so timely is to file that income tax extension by April 15th. Given the penalties that accompany a late filed 3520, this is a very important point as far as that goes. In addition, at least at this point, taxpayer, nonprofit organizations, tax-exempt organizations that file a 990, that deadline, which is typically May 15th for a lot of calendar year nonprofits, that has also not been extended as of today. Now, remains to be seen. We've got some time before those deadlines come out, but that deadline is still there.
And Mark, that also applies to fiscal year C corporations and fiscal year estates that might have returns due on May 15th or June 15th. Absent
Correct.
further relief, they are due without extension on their original due date.
Yep, I believe that to be the case as well. And that guidance is on the IRS website, but you really have to look for it. And it's, so hopefully if you're in that camp, you're aware of that. And if not, hopefully you are now. The only other point that I wanted to look at or mention are taxpayers. There's a fairly large number of taxpayers who, with the change in the Tax Act in 2017, the change in the tax law in 2017, were subject to the deemed repatriation tax under Code Section 965, where, paraphrasing and boiling it down a little bit, taxpayers who owned an interest in certain foreign corporations were required to bring back and pay tax on, or at least pay tax on the accumulated earnings and profits as of the date of the 2017 statute's enactment. To mitigate sort of the financial strain on that, the Treasury Department allows the taxpayers to pay that in installments over 8 years, with the installments being due on April 15th of each year, regardless of whether or not, and it wasn't tied to your tax return, it was due automatically and could not be extended. The guidance specifically extends that deadline to July 15th too. So if you find yourself in that situation with a 965 installment coming due in a month, a little over a month, or a little less than a month now, that deadline has been extended as well.
Now, with the general extension of individual tax returns to July 15th, 2020, an early question got a quick answer, and that was, is the deadline for opening and for funding IRAs extended as well? In an FAQ, IRS has indicated that you may open your IRA and fund it up to July 15th of 2020. C corporations who were extended automatically without filing an extension may fund their retirement plans for 2019 up to July 15. Of course, by filing an extension prior to July 15, then they will have an extra 2 or 3 months, depending on the entity, to fund their 2019 retirement plan contributions. Now here, Mark, is an interesting issue that I've seen talked about on listservs, and that deals with going forward. Suppose you discover in 2023 that you made a mistake on your 2019 tax return. Do you have to July 15th of 2023 to amend the tax return, or do you only have until April the 15th? And similarly, does the government have the extra 3 months as well? Any thoughts on that?
I've seen it talked about. I mean, I think as always, it's better to err on the side of caution. But I think there's, I expect that there will be guidance forthcoming. But in absence of that, I would, be sure to be vigilant on those deadlines in particular, and try to get it done by the original due date.
And we conclude by looking at news release 2020-59, which tells us, at least as of several days ago, where IRS is in responding to the current situation. IRS has allowed individuals to suspend existing installment agreement payments, and if they were making payments pursuant to an offer in compromise, they may suspend making those payments until July 15th, 2020, beginning with any payment due on or after April 1. Interest continues to accrue. Existing passport issues where you've already been certified as a significant tax delinquent are unaffected, but IRS will not seek to cancel any new passports during this emergency. Also, no referrals to private debt collectors during this period, and most liens and levies will not be imposed, the exception being in the case of certain high income taxpayers, and none will be imposed automatically, and most audits will be suspended during this period. Of course, IRS has cut off any in-person meetings as well. Mark, anything to add here?
Well, yeah, I mean, the service is no different than the rest of us. I think it's been, if anybody listened to this probably has some interaction with the Internal Revenue Service to some extent. It's been largely unavailable in terms of reaching a live person in the last week or 10 days. That's expected to come back online slowly. They're reallocating resources, I know, based on the discussions with folks there that I've had. There's a lot of, I guess not necessarily an IRS related issue, but most of I would urge people to also check the enforcement and collections areas of any state agencies in which they're dealing with too. They're all similarly situated, and they're providing very liberal relief for taxpayers in this difficult time. So that's there as well. But I think going forward, as the service adjusts and as businesses adjust, I think it'll get back to being business as usual. But it is a little bit of a transition time at this point. So there's some opportunities there, I think, for taxpayers who have some delinquencies to take advantage of this period to come up with a strategy to get compliant. Revenue collection, if you have a case that's currently with a revenue officer, there typically are still working those cases to some extent, but as Dave noted, except in very extreme or egregious cases, you can expect very, very little in the way of levies or other forced collection action.
And I do understand, Mark, that as of about April 1, at least for now, due to reallocation of resources, that IRS has shut down its practitioner hotline.
It has, and in fact, until yesterday afternoon late, and I think it may still be the case that they only have there's one fax number to the CAF unit that accepts IRS powers of attorney, and even that number, while the fax will go through, the message that you get is that it's going to take them much longer than usual to process those powers of attorney. So I think you've got to exercise a degree of patience in that and understand they're working through this too.
Well, ladies and gentlemen, thank you for joining us today for a presentation on tax issues during the current situation on behalf of Mark and all of us here at Stein Sperling. Be safe and be well.
Thank you very much.